In this video, we're going to go through the accounting entries for transferring an asset into a business corporation using Section 85 rollover. This is an article that's on our website, which you can get to ngtax.ca/transfer of personal assets into a corporation. In the article, we go through an example of a simple situation where a piece of land is transferred into a corporation for full deferral. One thing you'll want to make sure of before doing this transfer is that you have checked that whatever it is that you are transferring into the corporation is an eligible asset under Section 85 rollover. So we will publish another article at a future point outlining the types of assets. But in general, certain assets, like if you are transferring land that is held as inventory, so for example, perhaps you're a builder or a land developer, that land would be classified as inventory and is not eligible for transfer under Section 85. So you need to be very careful that your transfers are eligible, and of course, you'll need to have a proper legal agreement in place to transfer whatever the asset is from your personal holdings into the corporation. So let's get started by having a look at the accounting entry. We're going to have a look at how this transaction gets recorded in accounting software. So we've got a QuickBooks set up, and there's no transactions in this company except for the transaction that we are looking at recording. So I've already booked this transaction through. It is a balance sheet transaction, so all of the entries will be found on the balance sheet. So to get to the balance sheet, you go on the left, Reports. And then when it loads, you'll see balance sheet under the favorites at the top left. If not, you can also find it in our business overview. So we're going to load that up. And then we're going to make sure that we're in the correct financial year. So, we'll say we want to scroll up to this year and run it. The transaction we reported was at January 1st, 2024. So this covers that entire period. And our entry was an increase to land at the carrying value. So when the seller sold us the land, that was the cost to them. And in our case, this is a non-arm's length transaction. So it is a related party transaction. So in our case, we are transferring the land into the company. So this was our cost, and we're deferring tax on it. So the total value of the land is $500,000. We've recorded it as cost as the buyer, $200,000. And then we need to have another debit side to get us up to $500,000. And that debit we've put to retained earnings and created an account called Retained Earnings Tax Plan Rollover. And that is consistent with the accounting standard 3251 equity section that talks about when you have a financial liability set up for preferred shares that you put the charge through retained earnings. And in this case, we're going to keep a separate retained earnings account so we can keep track of it. To create a separate retained earnings account in QuickBooks, sometimes it's a little bit tricky. So if we go into the chart of accounts, when we look at our retained earnings, you'll see that the type of the account is an opening balance equity. You can only have one retained earnings type here. So when you are creating your account under new and you are selecting your type here, so equity, you will try to select retained earnings here. And let's just call this test. And you click save, and it will give you an error. There can only be one type of retained earnings. So what you do is you change this to opening balance equity type, and then type in your account here. So in our case, we called it retained earnings opening balance adjustment. So if we go back here to our balance sheet, we'll see that we've taken care of the debit side with the $200,000 and the $300,000 to equity. And on our liability side, we have a note that was issued equal to the cost base of the land, or equal to the elected amount if you're doing a Section 85 rollover and deferring the tax. Then we also have a credit to preferred shares, which equals the redemption amount of the preferred shares that are mandatorily retractable. The reason we have preferred shares in our liability section is because these are preferred shares issued under a tax planning arrangement, and there is a liability of the corporation to redeem those shares at the option of the shareholder. So they're retractable. And that's why they are a liability as opposed to being in the equity section. So if we were to look at the journal entry for this entire transaction, so if we click in here, click all dates, and we'll see we have one transaction. We'll see that we have a debit to land, credit to note payable, credit to preferred share, financial liability, and credit to retained earnings, or debit to retained earnings. When you set up your preferred shares, make sure that you set it up as an other current liability so that it falls into the correct category. Need some help with anything you've seen in the video or have some questions? A link to our contact page is contained in the description below. Please make sure to like and subscribe to our channel. It motivates us to keep making videos.